So how do you determine the directional bias of any given market? Now, the truth is, this isn't easy. Understanding market narrative and market bias is one of the hardest things that you can do. So I'm not going to sugarcoat it when I say that it is difficult. However, there are certain rules you can use which will help you to determine the directional bias. So I'm going to keep it extremely simple and only use a few concepts that you can get familiar with. Now, if you haven't seen my previous video on my explanation of ICT concepts in regards to time and price, watch that first, because that gives you a whole lot of insight into what's actually happening behind the scenes, right? You're still going to need to take this information and backtest it yourself. This is not the type of channel where I say this is easy, but it can be simplified, and it's still going to require work on your part. But I promise by the end of this lesson, you'll have a better understanding on what to look for when you are trying to establish a directional bias. And this can work across any time frame, whether it's the weekly, the daily, the 1 hour, the 1 minute. The concepts are the same because price is fractal. So let's get into this chart. Now we are here on the weekly time frame, and this is for the US dollar index. The first thing you want to do when you are trying to establish the current directional bias of the market is you need to assess what price has previously done. I cannot stress how important this is. It is very difficult to determine directional bias without first looking at what price has already done. Where has it been? Where has it already visited? And what's the likelihood that it needs to revisit that area? So these are the first things that I'm asking myself when I'm trying to establish a directional bias, right? Now, what do I mean by that? In this example, we can see how the market has sold off. Now, where has it come to? An inefficiency in the form of this buy-side imbalance. Again, as explained in the previous video, price is only going to seek two things: either liquidity that rests above old highs and below old lows, or to rebalance inefficiencies in price, whether it's buy-side or sell-side. In this case, we have seen price drop into this buy-side imbalance. But what is occurring over here? There's a few clues firstly, right? We can see the body of the candle over here. It stops dead at the consequent encroachment, which is the midpoint of this buy-side imbalance. Again, I've explained what buy-side imbalances and sell-side imbalances are in the previous video. This is the first clue. It suggests that price doesn't want to go any lower. This could be good enough for a long entry, and there are several factors why, but that's beyond the scope of this presentation. But what we are waiting for is feedback. Once this candle closes, the next candle, you can see how we dropped lower, again back into the consequent encroachment of this buy-side imbalance. And then what happens is we have a really sharp movement higher with an up-close candle, leaving this fair value gap in the form of this buy-side imbalance. So from this candle's high to this candle's low, we only have price moving in one direction, buy-side. This is significant. This tells us that the market is in a hurry to reprice higher. Now, once this candle closed and we had the formation of this buy-side imbalance, the next candle opened, traveled lower slightly into this wick, and then closed back above this candle's high. So we have broken a swing high over here after forming a swing low down here with a displacement after rebalancing this buy-side imbalance. So when we see this, this gives us an indication that the market is likely to draw higher. Now, the market is likely to first reprice to equilibrium, right? So this is our dealing range high, and this is our dealing range low. If we split this range into half, we get our equilibrium level, the midpoint between the dealing range high and the dealing range low. So this would give us an initial upside objective, which would be to reprice back to equilibrium. Equilibrium is essentially fair value, right? It's the mid price point between this high and this low. So inside of this range, this is our highest premium price, and this is our lowest discount price. Therefore, equilibrium is going to be fair value. And as I explained in the last lesson, the markets are booked based on principles of fair value. Anything below the equilibrium price point, this is referred to as our discount range, and anything above the equilibrium price point is referred to as our premium range. Generally, the markets will move from premium to discount and discount to premium. In a bearish market, ideally, we want to wait for price to come into a premium before we sell short. And in a bullish market, we want to ideally wait for the market to drop into a discount before looking for a long entry. You can see how this swing low to this swing high, we are obviously below equilibrium level and into a discount relative to this dealing range. Now, since we have seen what the market has previously done down here, and we have conviction that the market is giving clues that it wants to run higher, we want to look for areas that the market would target above the equilibrium level. Now, again, like I said, there are two things that the market will reach for. It's going to either reach for liquidity, in this case, buy-side liquidity above these relative equal highs, and or is going to reprice to rebalance. And over here we have this sell-side imbalance where the market has moved in one direction only, sell side. And this sell-side imbalance sits inside of the premium range relative to this high and this low. Let's zoom in onto a daily time frame, and this will give us more detail. So here you can see the 3-candle formation, which is our swing low. Again, I'll do a separate teaching on this at some point. After that swing low has been created, you can see how we have this displacement higher. Now, price has retraced back into this displacement, but it hasn't fully rebalanced this buy-side imbalance. Why? Well, if we look to the left, we have this sell-side imbalance here. And then back through that range, we have this buy-side imbalance. So this area has been sufficiently balanced with both sell-side delivery and buy-side delivery. And this fair value gap now will act as an inverse fair value gap, and we anticipate this level to hold price. You can see how we're consolidating above it, and notice the bodies of the candles here. They're failing to even dip lower into that inverse fair value gap, which again suggests that we are looking for higher prices. On the daily time frame, if we look above the equilibrium level, which is this green line, we can see that we have this large sell side imbalance here as well. And this sits inside of a premium. So in this case, we have an overlapping of fair value gaps between two different time frames. And we still have all of this buy side liquidity above the market. And this is even stronger since we have two parameters here in close proximity. We have the buy side liquidity residing above these relative equal highs, and we have this sell side imbalance that sits above those relative equal highs. So we have liquidity and an inefficiency in a premium relative to the dealing range high and the dealing range low. Now, this gives us a range of opportunity between this inverse fair value gap and this sell side imbalance. So this is going to act as a very strong magnet and a very strong draw on liquidity. And this gives us a range to now work with. Ideally, you want to trade on your lower time frames in the direction of the higher time frame draw. We have concluded that the weekly expansion is likely to run higher. Now, there are several entry techniques and a whole lot of other stuff that I'm going to get into at some point. But for the purposes of this lecture, we are just trying to determine where the market is likely to go, right? Now that we've arrived at this level, we are in a premium. We've completely rebalanced this grey shaded box, which has our higher time frame weekly sell side imbalance. And we're currently consolidating around this area. Now, there are a whole lot of other clues over here that can tell us where the market is likely to go. But again, beyond the scope of this presentation, however, when we are trying to establish a draw on liquidity, we need to look at the market in a series of if and then functions. We are inside of a higher time frame fair value gap here, and the market could just go into a consolidation. So what are we looking for? We're looking for displacement, and this displacement is going to give us an indication of where the market is likely to draw to. If we close back above the weekly sell side imbalance, then we can anticipate price returning back to the premium end of that weekly sell side imbalance, and that holding as support, which would then become an inversion fair value gap. And we can aim for the complete rebalance of this area, or we are looking at these relative equal highs up here. There's going to be a large pool of liquidity resting above this area. For the more advanced students, you can see this as a market maker model. Now, that's a very, very long conversation. I have a whole course on that. So if you are interested, that course alone is a game changer. But to keep things simple here, we are looking for one of two things. Either we are looking to close above the sell side imbalance, and it would act as an inverse fair value gap, and we would find support, or we're going to close below that weekly sell side imbalance, in which case this would act as a balanced price range since we are fully balanced here, and the discount end of that sell side imbalance would act as resistance, sending price lower. If this were to play out, where would we target? Well, we have these relative equal lows over here, so there's going to be a pool of sell side liquidity resting below that. And just below those relative equal lows, we have this gap. So since these two are in close proximity, this would act as a strong magnet for price if we are to push lower. This is a common misconception that I've seen with many of my students, is that if you establish a bullish bias, then they think that the bias is going to remain bullish until we clear the highs up here. That doesn't necessarily mean it's going to clear the highs up here. We could turn around from where we are. This is why you have to constantly evaluate and assess what the market has already done and what it could likely do next. If this has happened, then this is likely to occur. At the minute, we have completed 3 of the objectives. We have run above the equilibrium price point, so we've gone from a discount into a premium. We have cleared buy-side liquidity above the relative equal highs, and we have fully balanced the higher time frame fair value gap. So what's my bias now going to be? Neutral, until I see some form of displacement. You have to allow the market to tip its hand, and then you look for clues. Okay, if the market has done this, then where's the next likely direction? And then on the lower time frames, you stick with that bias until you are proven otherwise. From where we are, I'm anticipating price to break lower. That's what I want to see. I want to see a displacement lower and leave a fair value gap. And then I want to see price come back into that fair value gap and then potentially run lower for the sell side liquidity here and close in this gap. Again, I would have to assess what price is going to do once we get back down to this level. Do we run through it? Do we displace through it? Do we close back below it? And how do we close back below it? All of this is going to give me insight and feedback into what I will anticipate price to do next. In conclusion, price is going to seek to do 3 things. Move to equilibrium since it's fair value, reprice to liquidity in the form of old highs and old lows, and rebalance inefficiencies in the form of sell side imbalances and buy side imbalances. Your job as a trader is to determine the probability of the market moving in one direction over another. So you want to wait until the market looks extremely one-sided, that is obvious it's going to move in one direction over another before you start looking for trades. So in the words of ICT, I hope you guys have found this one insightful. I will be getting into more detail, and there's a whole lot of videos I have planned. If you haven't downloaded the ebook already, I strongly suggest that you do. There's actually a free gift that comes with it, with one of my actual mentorship videos, and you can see the level of detail that I really go into in that. But for now, try to keep things simple. Define your dealing ranges into premium and discount, and look for the inefficiencies and the areas of liquidity inside of that range. So thank you for watching, and I will catch you again in the next video.